On another tough day for the markets and the world, Guy Adami. Obviously, let's do what we do here, and that is focus on investments and give some sound advice. The VIX fell today, but it's still at 53. Volume was down, although still elevated from a month ago. But all in all, I think you might agree, another reasonably orderly day for the equity markets.
Yeah, I'm glad you mentioned orderly, and again, great to see you, Brian, and everybody else. Orderly is a good word. I think you can't underestimate how important it is to get back to some semblance of normalcy in the markets. And listen, I get it. The VIX at 53 is still an absurd number, especially when you look at it in the context of what we were talking about 3 or 4 months ago. But that's off, obviously, the recent highs, and it moved lower today despite the broader market moving lower as well. That's encouraging. I don't want to be Pollyannish here. I get it, the market's down. But I took some good things away from today. That and the fact that there continues to be some semblance of normalcy again in the bond market. So those things are encouraging, the S&P and the Dow notwithstanding today.
Tim Seymour, did you find anything, or maybe the same or different,
Brian,
encouraging about this market today?
Well, I mean, at midday, we did our production call as we do, and we were all looking around and seeing the S&P up 33 basis points and saying, wow, this is like a lovely July day. What the takeaways are, markets certainly have priced in. If you're the bull, you say that risk markets have repriced based upon the coronavirus, that we have an enormous stimulus package. We have a central bank that's buying everything that moves. And this is a case where pessimism got to that point where there was extreme. Bears are going to rightly point out that we have no idea what the economic data impact is going to be, and that we know the data this week is going to be poor. We know we got some terrible PMI numbers. But at some point, these are the moments when data bottoms, and I'm not saying that we have, is when you want to be buying equities even though the world doesn't seem to be a great place. I think that's where we are wrestling right now, and I would continue to say, Brian, that I think we got to peak pessimism already. And I think that's something that is generally good for the markets when you have this wall of worry.
I'll tell you what, Tim, I wish you were right. I wish it was an average July day. That sounds pretty good right now. Karen Finerman, it's great to, quote, see you, even though I can't see you, but our audience certainly can. I mean, you look at this market, Goldman Sachs coming out with a second quarter GDP estimate for a contraction of 34%. I mean, I think Tim used the term cartoonish with some of these numbers yesterday. As a fund manager, do you pay any attention to this data, Karen?
Well, I mean, that's a pretty unbelievable headline. I think that's an 8.5% quarterly GDP contraction and then annualized. But I mean, either way you slice it, even a quarter of it's still a horrific number. I think that is possible. I mean, who knows? Who knows what kind of contraction we're going to see? But I've been pleasantly surprised. Both Tim and Guy talked about a little return to some normalcy. I mean, this was just sort of your run-of-the-mill down 400 and change day, which actually didn't feel bad at all relative to some of the other days we've had. The credit markets opening and functioning, that's really important. I mean, the idea that today Carnival Cruise talked about doing a debt deal, a junk deal, and a convert and equity, that's astounding to me that they would consider that. So, I mean, 10 days ago, that would have been absolutely a complete non-starter. Now, I don't know if they get it done. We'll see. But just the idea of that is sort of amazing. Maybe they don't have any choice. They got to do it no matter what. But it's good to see the debt markets functioning. To me, that's more important, actually, than the equity markets functioning. So I feel a little bit,
Chris, I was trying to play my best.
34.
Chris Verrone earlier today. I was looking at some technical analysis, and I looked at a longer-term chart of the S&P, and I saw that we pretty much bounced exactly off that RSI, that relative strength indicator, a couple of days ago. And I wonder, when you look at this market, we knew for a while during the absolute darkest days for the market of a couple of days ago, technicals seemed to be mostly out the window. Has a sense of orderliness also returned to the patterns, the charts, the things that you look at?
Yeah, Brian, I think it has. And listen, I know that we don't know here. We're all playing in the dark. But when we put this into some type of historical context, and I think as Tim talks about as well, you were in the historic oversold camp. The number of stocks making new lows about 2 weeks ago was as bad as we've seen since 2008, worse than we saw at 87, worse than we saw at the 62 low. So to put this into some type of context, you have to go back to those data points and say, okay, how did market respond from here in the past? And what we see historically is the returns over the next number of weeks or even over the next couple of months can be very, very random. But looking out 6 and 12 months in the future, they tend to be very, very, very strong. I think it's notable that under the surface, even on a day like right now where we had S&P lower, risk was actually not bad. High beta better than low beta, semis were better than software, and breadth was not bad. You had just as many stocks up as you had down. So I think the internals are starting to thaw. We've seen that in corporate credit. We've seen it with the VIX. We've seen it with put-call ratios. Those are some helpful signs under the surface.
Yeah. You know, Guy Adami, I don't want to get personal. I don't know about you, but I can tell you this much. When we do our 8:15 company-wide call, the moment I get off it, I get on Johns Hopkins, I get on NewJersey.com. I start to look at case totals from around the world, from the United States, from New Jersey, from my county in New Jersey, obviously looking for some signs of hope. Is that the primary data point that we've talked about before that will ultimately move equities? When those numbers, as bad as they are, start to roll over and go down, we're talking about humanity, are those the key data points rather than the Goldman Sachs GDP number?
Yeah, I mean, Goldman Sachs GDP number, I mean, anybody can throw a number out there. I get it. I understand that. To Karen's point, there's no way of knowing what has come out. I think your point is exactly right. And that's actually what sort of scares me a little bit, because everything you read or hear or watch on television indicates that, you know, we're probably still 7 to 10 days away from this thing at its worst, which is really somewhat disconcerting. So I am hoping somehow that the market has discounted it. But, you know, I think if we were to see those numbers escalate and if we were to see the things that they're warning us against, that could be somewhat disconcerting. Now, I'll say again, it is good that we're getting back to some level of normalcy here. I'm not saying we're going to retest the lows. I have no idea. I do think there's a chance, and I think Chris Verrone would probably accept this as well, that we do a 50% retracement and maybe trade up to that 2790 level, which makes sense. But, you know, with that said, to your question, I think that's the overriding factor right here for everybody.
Yeah, Tim, would you agree with that?
Well, I would. I do think we have some data points. Remember when we first started actually kind of turning a blind eye to what was going on, and I mean markets. We're turning a blind eye to what was going on in Asia, certainly in China. We got some sense that this was going to be a moment. And even for investing in emerging markets and Asian securities, it was a sense that we'd seen this before with SARS, and that 2 to 3 months out, certainly 9 to 12 months out, this was something you had to have been buying as an equity investor. Obviously, the entire world changed in terms of the magnitude here. But hey, China's back. China was 3 months ahead of us in terms of the impact. And I'm not saying that looking at China macro is something that should necessarily parlay into the U.S. economy. But last night, China released PMI, manufacturing numbers and service numbers, which were in expansion territory. 52.3 on manufacturing, 52.0 on services. And these are numbers that were drastically better. And I realize that, again, off of what base and off of what comparison, but that's the good news. The good news is that China's second quarter GDP, we talked about U.S., is going to be down 1% in the second quarter. So the duration, and this is back to your question of how long before we get to essentially inflection points in this country, is somewhat determinant on how bad the economic impact is going to be. But we have data points of companies and countries that are further along in the process than we are.
Yeah, South Korea, China, great points. I want to get to our guest in a second, but Chris Verrone, we got headlines crossing right now on CNBC.com from Jeff Gundlach, obviously known as a bond fund manager, but a guy who will wade into anything. And Chris, Jeff saying that the coronavirus sell-off is going to worsen again next month in April, taking out the March low. So Gundlach, and I got one headline for you. Gundlach obviously bearish on equities, thinks we're going to make a new low. Agree or disagree?
I disagree. And listen, I know that we don't know here, but what's important is this market deteriorated before anyone figured out how bad this virus was. So I would apply the same logic on the other side, that this market will begin to heal itself before anyone can believe that the virus data will get better. And we'll look to corporate credit markets, we'll look to dollar funding markets for some evidence of that. And I think that's where the Fed has been pretty effective over the last 2 weeks. We have returned to some normalcy in the macro world. And I think the most consensus word out there is retest. Everyone's talking about a retest. They're only retests in hindsight.